Hello, hi everybody. Okay, test, 1, 2, 3, 1, 2, 3. Okay. Alright. Hey guys, I'm back. I haven't made a podcast in quite a few months. Almost like July. The last time I did a video, or just an audio. This time I added a video format, so if you're listening on a podcast, um, maybe you want to go onto my YouTube channel and see what I'm gonna be sharing because I'm gonna be sharing a lot of charts, a lot of graphs, a lot of information. Okay. And yeah, so just welcome back to another episode of JB&D's Market Sniffs. You get it? Because D is for Dino, and he's a dog. And dog sniff. And we're sniffing the market, trying to look for little golden nuggets to make some money. Okay, anyways, so here's what's been happening with me. All of November, I took a break, didn't trade. Yeah, pretty much did nothing for the whole month of November. Reason being is because I've noticed that I've always had a red in November. Every November, I've always had losses. So I was like, okay, you know what? Let's just skip. Let's just skip it. If I have a backtrack record on November, I'm just gonna skip it. That's what I did. However, I still ended red. Market was red. But realized I was green. From some swings from October that I realized at the end of November. Um, it is what it is. But now I'm recharged, refreshed. I'm ready to go. Um, I just been playing soccer, just sleeping in, just chilling. But yeah, I'm ready to go now. So it's December 3rd. I did some reading 2 days ago, December 1st. Yesterday I was busy, so I couldn't really do anything. Did a little bit more reading today, and I compiled some things. Okay, let me show you. Okay, so okay. Anyways, so I have a little Discord, just myself. It's just so that I can throw in all the data that I collect, all the information that I collect into here, and yeah. So give me 1 second because Dino has some skin allergies and he's nibbling on his skin, so I'm gonna put on his cone for a little second. Excuse me, Dino. Come on. Okay, it's okay, Dino. All right. Okay. Anyways, so I have a lot of reading to do. Look, let me show you my list of things that I need to do. Um, let me show you. Or actually, I'll just tell you. Okay, I have read Barron's articles, read Tom's articles. Tom, um, if you know, you know, really good guy. Share some value info. You can search him up on YouTube at Hedge Fund Tips. Um, Hedge Fund Tips. You'll see. Um, a lot of the stuff I learned from him, as well as a few others. Okay, and read Charles Schwab articles, read Zero Hedge articles, read Apollo newsletters, read IBKR articles, read BOFA articles, read Market Year articles, and chart. That's a lot, right? So thus far, I've done read Market Year articles from Zero Hedge, read Bank of America articles, read Interactive Brokers articles, and read Apollo. Okay. Well, what we're gonna go over today in this episode is Market Years by Zero Hedge and Apollo. Okay. I throw all that in these last 2 3 days. You see, December 1st. Okay, and before we keep going, I just want to say I do ramble a lot, so I'm sorry. I know that I can make the points that I make much sooner than when I do. It's just how I am. I'm sorry about that, but especially right now, since it's been a while that I've recorded the video, I'm gonna be very very slow. Okay. Anyways, let's just get started. Okay, let's just go. Let's just go. We're gonna go over that, and then at the very end, I'm gonna go over some charts. Okay. Okay. So all these black charts that you see, the black ones are from Market Years by Zero Hedge, and the white ones are from Apollo, um, by Torsten Slock. Okay, so let's see this first one. Okay, SKU sitting at its lowest level in a while, and more importantly, downside protection has seen a massive reset. Okay, this is for S&P 500, SPX. So there's not a lot of protection going on right now, which you want to buy protection when you can and when you have to. You want to buy earthquake insurance before the earthquake, not after. Okay. Um, okay, here SPY put call ratio again has dropped. It was high at the very bottom of November, dropped down, and now we're here at some lower levels. Okay. I want to go back to, let's go look at December. Ooh, December of 2024, January 2025. Okay. I just want to see because, well, I'm seeing a lot in terms of the charts and macro. Um, it's very similar to exactly a year ago. So I just wanted to see. I just wanted to compare. Okay. Anyway, um, derivatives gurus, Coppersmith, Garrett, and Halfif on the latest VIX stream. The 5-day retracement VIX is one of the largest on a 5-year look back. Okay, look at this pullback. The last 5 days on the VIX, very very big. January 2025. This one right here, that's probably April. This is probably December, August. So it's usually a market top or a market bottom. In this case, since we're at the top, I say this is a market. No. I'm gonna just stop yapping for a second. Hold on. Let's just keep going. Volatility, S&P 500 index seasonality. Going into some volatile months from January to March. Again, let me show you. Let me show you something. Let's pull this up real quick. I tweeted something about something looking very familiar about the year. And I told you right now. So we are essentially in the same spot as we were last year. Volatile end of year. Highs, we're at highs. Okay, we're expecting more rate cuts. Same economic worries. Leverage is at highs. Same as last year, exactly a year ago, November, December, January. And my question is, are we going to follow a similar path of the last 12 months? I think we will. So I think I'll be using the same playbook that I used in 2025 as in 2026 in relation to the U.S. equities. China, the China has actually gone up since a year ago, so things are a little bit more different. However, it's still undervalued compared to the U.S. Anyways, let's just focus on the U.S. right now, okay? Same, like literally, it's like you could have fallen asleep for a year and you think we're in the same, like nothing has changed. You think that you slept for a minute because what the hell, we're like in the exact same spot basically. Anyways, okay, so yeah, we're going into a volatile season. And sure, you're gonna say, and mid-December to end of December is usually bullish. Okay, however, from now to then, it's pretty much flat seasonality wise, and but I don't know because look, when we go over the charts, you'll see. But I'm not bullish right now. I want it to be, but I'm not. Okay, let's see. This is from Apollo. Okay, the chart below shows that foreigners come to the U.S. to earn higher yields and invest in AI. Okay, those are the two major tailwinds that bring in foreigners: higher yields and invest in AI. Okay, since Liberation Day, foreign appetite for U.S. assets has been robust. This is the reason why the U.S. dollar has been trending higher over the past 6 months. Okay, you see the total, the treasury bonds and notes, and equities. Okay, that's the biggest two reasons. All right. Here's my question though. Okay, we know that Trump is about to announce a new Fed president, which is what's his name? I forgot his name. It starts with K, Kevin or something like that, or I don't know. Again, it's past month I haven't really been keeping up to date. Okay, my question here is: if we get aggressive cuts next year, does that not remove one of the tailwinds for foreign investors, which is that being the higher yields? Obviously, aggressive cuts, lower yields, right? Add on the hypothetical Japan hikes, because a lot of people are talking about the carry trade, whatever. But there's a chance of that they don't even hike. But let's just say they do. Let's just say they do. That would see more selling of U.S. assets. Okay. Um, let's add on another thing. Add on China's AI rise without a grid constraint, um, which I could go over in a deeper level maybe on another episode. Look, let me just give you a quick overview for that. I added something about that not that long ago. Okay. Okay, just need to figure out what's a bigger problem to solve. The US with the power capacity shortages that can install data center development, or China with the data center efficiency issues. Okay, they have different bottlenecks, okay? The US power grid, that's the issue. For China, they have a lot of data centers, but a lot of them weren't built for what they're needed at for now. But they do have a lot of capacity to build more. um, okay, so again right here, U.S. power constraints could temporarily slow AI progress by 2030. China's grid size is twice of the U.S. ensures sufficient spare capacity for data centers and other industries. U.S. power market tightness has already triggered spikes in real-time power prices and capacity costs. Okay, so here, summarize right here. U.S. power constraint. The limiting factor for U.S. AI developers is no longer money or talent, but electrical power, with gigawatt scale energy now required to train frontier models. China, on the other hand, is efficiency driven. With restricted access to top tier chips, China has built a model of forced engineering efficiency, producing competitive AI performance through smarter optimization rather than hardware advantage. Okay. Oh, one more thing. See, I'm already here deviating this because there's a lot of juicy stuff to get into. Whatever. Chinese hyperscalers will spend US 124 billion on capex from 2023 to 2025, 82% less than the US peers of 694 billion estimated. Yet China's top AI model trails the best US by only 10%. Okay? China is spending 82% less on hyperscalers, yet their best AI model only trails the US best AI model by 10%. Like, just like, how has what? Like, what? And you're telling me US AI stocks are priced up here, and China's AI stocks were priced up down here a year ago, probably here now? Like, this is crazy to me. What? A better return on investment with much less investment in hyperscalers. It's crazy, right? Again, here's the 4Ps and discounts and all that. Pricing for U.S. tech and Chinese tech, basically. It's crazy. Brazil here. Okay. Anyways, back to where we were. Okay, my question here. Okay, China rise without a grid constraint. Okay, so wouldn't that make the U.S. AI tailwind less attractive? Foreigners would notice these things and say, you know what, maybe we could play this AI thing in China where maybe there's better opportunity. Anyways, oh, and don't forget, it weakened the dollar from aggressive cuts. If that were to happen, that will probably lead to foreign investors seeing better opportunities overseas. Again, if you didn't know, the U.S. dollar usually correlates with a stronger overseas international performance. Um, yeah. I'm not trying to be biased here. It's just what the data's showing me. Um, a lot of things are just pointing to unfavorable outcomes for U.S. equities, at least in tech. And I, by the end of this, you'll probably think like, "Damn, this guy sounds super bearish." Whatever. However, I'm still long U.S. equities. I'm just not long U.S. tech equities. I'm not long U.S. overcrowded equities. Okay, and we'll go over that later. Anyways, let's keep going. Another chart by Apollo. Aggressive cuts with new Fed press could push inflation if 2/3 of inflation is demand driven. Okay, so right here the chart says roughly 2/3 of inflation is demand driven. Okay, so just here, think about this. Let's say we get the new Fed president, and as soon as they come in, they start to cut rates aggressively. Okay, but think about this: 2/3 of inflation is demand driven. Okay, so if you cut rates, sure, it's gonna give a boost to consumers in the short term, which means they'll spend more, okay, which is gonna drive up inflation even further, and then that's when things start to fall apart, okay? Fall apart. Why do I say that? Well, let's go here. Um, let's go to the market year. Okay, lessons from the 80s. In the mid 1980s, the Fed cut rates by over 500 BPS in 2 years, the fastest easing outside of a recession, as inflation collapsed. Okay, as inflation collapsed outside of a recession, a sharp drop in oil prices and worries about a strong dollar added to the case for easing. Do we have a strong dollar right now? No. Have we had a sharp drop in oil prices? No. We've had a drop in oil prices, but I wouldn't say sharp. Okay. Where was I? Okay, added the case to easing, but in real terms, the cuts looked less dramatic because inflation had already fallen so much. Okay. Um, I wouldn't say inflation has fallen so much. We're at the 2% level, 3% level. Fed wants 2%. I think they're trying to normalize 2% now. Anyways, not really the case here, as it was in the 80s. The result: no overheating and extremely strong equity returns, with the S&P up 26% in 1985 and another 15% in 1986. Okay? But do you see the contrast from then and now? Again, let me just go over this one more time, okay? The fastest easing came outside of a recession. Inflation collapsed. As inflation collapsed, a sharp drop in oil prices. We don't have those three. Some people will say we are already in a recession, K-shaped economy, whatever, right? But I mean, GDP is still growing, or it's not falling. Strong dollar. We don't have the strong dollar. Inflation hasn't collapsed. It's not going crazy, but it hasn't collapsed. And we haven't had a sharp drop in oil prices. We've had a drop, but not sharp. And as a result, we had a very big outperformance the next 2 years. Okay. Well, again, we don't have those four things. Okay. Let's go. Let's go. Lessons from the 60s. Okay. In the mid to late 1960s, the Fed cut rates by about 200 BPS after a credit crunch, helping stocks rebound from the 1966 sell-off. Okay. But the easing ran straight into soaring Vietnam War spending, pushing deficits higher and inflation from 2.4% to nearly 6% by 1969. The Fed then tightening hard, contributing to the 1970 recession with the S&P blah, 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 blah. Okay, point is right here, things fell apart after they started tightening after inflation. Okay, so look, we don't have a war, I get that. However, the war was the reason why they started spending so much, pushing deficits higher, right? Our thing wasn't the war. Our thing was COVID, which pushed spending and deficits way, way higher. We have the high, very high, ridiculous high deficits, okay? Inflation, it spiked up after COVID and came back down a little bit. However, as I said, if we get those aggressive cuts again, or like we saw in, what year was it when the market fell? 2022, 2020, 2022, 2021, I don't know. We had a spike in inflation and then things fell apart, right? Now inflation came back down, things are good again, whatever. In the stock market, and I wouldn't say so much in the economy, but in the stock market, um, Fed cuts aggressively. If 2/3 of inflation is demand driven, what happens? Inflation goes back up. Okay, and inflation goes back up. That's when things start to get tricky again. The Fed might have to reverse course, tighten again. That's after all the damage has been done. And in this case, 19 when the Fed tightened hard, contributing to the 1970 recession, breaking below its 1966 lows, a policy mistake to help pave the way for inflation of the 1970s. Okay. um, you could say, oh yeah, we kind of already went through this in 2021, 2022, 2023, whatever years old. I think it was 2022. Um, but I guess this could be a second wave if we get aggressive cuts, because I guess the main catalyst here is inflation. Okay, from aggressive cuts, because 2/3 of the demand is of inflation is demand driven. Lessons from Japan in the 1980s. Bank of Japan kept easing even after the economy had already returned to growth, and approach later seen as a contributor to Japan's massive asset bubble. After a single quarter of contraction in early 1986, the Bank of Japan cut rates by 150 while growth was rebounding. The low rate fueled borrowing and the reach for risk, and by the time the tightening again, inflation had picked up. Okay, okay, easing after economy had already returned to growth. Okay, we're easing. Economy has already returned to growth. Still easing. We're still gonna ease. Um, while the economy by investor and Wall Street standards is doing fine. Again, I say Wall Street standards because to regular folk, it doesn't feel like that. Okay. Um, okay, after a single quarter of contraction, Bank of Japan cut rates, and then another. Okay, while growth was rebounding. Okay, didn't we have a quarter of contraction? We had one quarter. Wasn't that when we had the tariffs? Mistaken. I'm not sure if I'm correct there. I might be mistaken. The low rate environment fueled borrowing, and he reached for risk. And by the time the Bank of Japan tightened again in 1989, inflation had picked up. By the time, okay, again, inflation had picked up. Okay, and then okay. Yes, inflation's not that bad. Sure. But again, if we get those aggressive cuts, we could get a rise in inflation, which by that time things will not be good. Um, okay, because literally again, oh, you get the point, right? Because I'm just repeating myself and repeating myself and repeating myself, just in different words. But oh my god, I think that was it for this part. Okay, yeah. I'm sorry. Anyways, I telling you, there's a lot of stuff to go over. Existing home price now lower than new home price. Interesting, nice. Uh, More than 9 in 10 renewable power projects commissioned in the past year were less expensive than their fossil fuel equivalent. Much of the energy required to power AI will continue to come from solar. Man, I should have bought that FSLR dip, first solar dip in April. Whatever, that's hindsight. Anyways, the equivalent of 3 New York cities of power demand will need to be added to the U.S. grid by 2030 to meet growing data center requirements. Complicating matters, over 70% of grid equipment in the U.S. is more than 25 years old. Correct me if I'm wrong, but I'm pretty sure I read somewhere months ago that average grid equipment lasts for the U.S. Um, is expected to last between 25, 30, maybe 35 years. I don't know. I'm pretty sure somewhere in between that range. Point is, the U.S. grid equipment at the moment is at that age where it's time for it to be replaced, be upgraded. Um, so yeah, old grid, man. Again, remember what I told you about China earlier. Okay, what do we have here? Asset price. Okay, here's the asset price. Multiple of starting. Okay, so months from peak. Okay, So these are past bubbles: Railways bubble, South Sea bubble, 1929 bubble, .com bubble, Mississippi bubble, Tulips bubble. Okay, as you can see, each bubble is different. Okay, each bubble is different. Some are shorter than others, some are longer than others, some are similar to others in terms of length. I'm not talking about peak. I'm talking about length. Um. Anyways, SPX versus Mag 7, 1 month normalized podcast skew. Okay, so this podcast skew, I think it's outdated. I'm pretty sure this is from early November, so a month ago now. Yeah, because okay, yeah, that's from a month ago, and then this is no, was it this one? Or was it this one? You see, yeah. No, that's yeah, this would be like the more accurate representation. Anyways, single stock put cost skew shows crowding into upside positioning. That was early November again. But then we had the dip mid November, and then we had the spike up. We're basically back where we were early November, so I wouldn't say it's too much different. Max 7 EPS. Look what happened back in earlier this year. We had such deviance. It's the same from July, summer 2024. Anyways, KPAC scores versus. Okay, this thing. Okay, typically, when a company is. Sorry. 1 second. Sorry. Sorry. Usually when a company spends so much on capex, you see negative returns. That's pretty much been the norm since '86. I guess you could see. Obviously, right now we've been seeing the opposite. All these Mag 7 companies spending so much capex, whatever, right? And the stock goes up, which is different from history. Well, do you think it makes sense to chase and think this time is different, or do you think what's currently going on is just an anomaly and we're probably going to retrace back, and these stocks are probably going to tank later on? You know, like just think. You don't have to short it if you don't want to. You can just stay out of it and focus on your own thing, like we are in our long terms. Um, Single stock options volume again highs. Yup. Mega cap tech call option volumes. This is from mid November, 2 3 weeks ago. That high is crazy, right? Sure wouldn't want to be long tech the year. Mag 7 1 month put cost skew equal weighted. At lows, no protection. Again, this is probably mid November again. God, I want to buy protection. It's out of favor. Retail flows as a percentage of every market cap. Yep. SP 500 stocks. And retail, man. Retail's going crazy. Anyways, total US call volumes, total US put volumes. Call volumes are. Yes, obviously, you'll say, put volume is all the way up, or is at highs, whatever. But that's because we just have more retail volume in general. Not just retail, like just in general, just more people are investing. Obviously, volumes are going to go up. But you want to see the difference between put volumes and call volumes, okay? And right here, this shows perfectly that call volume is way more than put volume. Anyways, we have free cash flow slowing for Amazon, Google, Meta, Microsoft, Oracle. Not really a good sign. Data center inventory by markets. This was from this Brazil. Let's skip over Brazil. I guess we'll go over it real quick, okay? Brazil P ratio. Man, I wanted to invest in this back in December. I didn't. I shut off. But again, hindsight, it's okay. Look, they have the third highest cloud AI usage per country. They have the second highest rare earth reserves. Data center inventory. Yeah, man. it's actually priced. The reason was because the chart looked good and because of all their natural resources that they have. But I opted out. Um, but I'm definitely gonna keep an eye on Brazil. I want to fall asleep on it. I think that's a sleeper. I think it'll be a big beneficiary of AI. Anyways, we went over this. We went over this. Oh, we didn't go over this one specifically. China, U.S. utility scale electricity generation capacity. Again, you see China, U.S. Electric capacity has gone up so much since 2010, 2011, when the U.S. and China crossed. U.S. just been flat. Anyways, U.S. holds 44% of global data center capacity, but faces power bottlenecks in 8 of 13 regional markets. U.S. power capacity is declining. Yeah. Meanwhile, public and private entities in China have invested billions in data centers, but an estimated 80% of new infrastructure stands unused. 80% of new infrastructure stands unused. Given the intensifying demand for data centers, hyperscalers are facing infrastructure constraints. New data centers set to be built out by 2030, 2028 are completely booked. Northern Virginia power capacity shortages causing project delays. Data center capacity. And for natural gas plants, because country is big in natural gas plants right now because nuclear is going to take a while. Natural gas is faster. They don't take that long to build. It's just the regulatory hurdles that take the longest. Anyways, number of nuclear reactors. China has so many more compared to any other country. Where's the U.S. in here? Don't see any. That's crazy. I'm pretty sure they have. Oh, wow. This article is a really good one. Not gonna go into it though right now. Quinn's cumulative downloads surpassing llamas for Meta. Nice. Here we show the patent publications in machine learning and artificial intelligence each year. China's university made much more than any U.S. university combined. Higher retail sentiment in China. It's higher than a year ago, but not at extremes. Good. I think this is China, no? Pretty sure that's to do with China. I think this is the percentage of funds, global funds. Something funds located in China. So right now, 7.1%. Yep. Rising electricity demand will require investment in new supply. Panic index. This November. This is more recently. This is like a week ago. Panic index has gone down, and you'll see a lot of people talking about the fear and greed index at lows. We're at highs, it's at lows. We can't go lower. We have to go higher. No. At these levels, as I said last year, in around this time, December, November, January. At these levels, when there's this much leverage in the market, at these highs, the fear and greed index doesn't hold as much value as it typically does. Fear could be at 2, and if we start with that amount of leverage, it doesn't matter. You can still go lower. And we saw something similar to that happen in March of this year. The fear and greed index was pretty low. It wasn't at 2, but it was pretty low. And people thought, we're not going to go lower. And 2 weeks later, we go much lower into April. Again, leverage at this point, with the amount of leverage outweighs fear and greed, okay? I just want you to know that. At least that's what I believe. And before we go further, I forgot to mention, nothing I say is financial advice. It's only opinion. Talk to your own financial advisor. Your needs might be different than mine. Your goals might be different than mine. Each person has different goals, different needs, different risk tolerance, different everything. So talk to your financial advisor. None of this is financial advice. I'm not responsible for any investment decisions that you make. Okay. Oh yeah, here. This is um, the spot PC, but the most recent one was the one that I showed you earlier. Median 2 week S&P 500 returns to 1950. First half of December, strong? No, yeah, no, it's on the lower end. These are the stronger ones, and then these are the weaker ones. It's still positive, but on the weaker side. First half of December. Second half of December, it's up here on the stronger end. Anyways, assets under management and leverage. Again, I'm talking about leverage. Assets under management and leveraged ETFs at quarters end. Just be careful. Just be careful. Please just be careful. Consensus EPS growth. Look at this. Just look at this. Okay, we're 2025. Focus on the light blue, okay? Nasdaq around 18%. Equal weight was, what was this, like 9-8%. S&P was 11%. S&P mid cap was at like 2%. Russell was at like, what I say, 18%. Okay, now let's go to 2026. S&P 500 is supposed to grow a little bit. Okay, expected to grow. Equal weights expected to grow a little bit more. More than the regular S&P is expected to grow from the prior year. Nasdaq is expected to stay flat, maybe decline 1%. Mid cap. Look at mid cap, going from 2% 2025 consensus EPS growth to 2026 15%. That's a 13% EPS expected growth. That's kind of crazy, right? Now, who has an even bigger expected growth? The Russell 2000 from 18%. I don't know what this is, to be honest. Up to 49%. So we have all these things that we already discussed, where we might see that are basically headwinds, that are gonna act as headwinds to US tech, to literally anything that's over leveraged, that holds little value. Okay, I'm not, when I say little value, I'm talking about like these meme stocks, these quantum stocks. I'm not talking about the Mag 7. Mag 7, obviously, they're good companies, they have value, but they're just overpriced and they're over leveraged, just as the meme stocks. Okay, their growth is expected, the big techs are expected to stay flat, while under the table we have all these other 483 stocks that are expected to grow a lot. Okay, where do you want to, where would, like, just think for a second, where do you think you should put your money? What do you think? Talk to your financial advisor. I don't know, I'm not an expert. Yeah, and then this is back to some stuff that I had in November, consumer staples, all that. But I want to go over one thing that I shared in this other room. From, come on, from it doesn't work. Oh, it was, what did I say? I said something about cash. It's probably here in long-term stocks, or is it? Let me check here. Yeah, it's not here. Okay, it's gonna be here, but in long-term channel, cash. Here we go. I found it. Here we go. I found it. This is from the Global Flow Manager survey a while ago. We need to go over this. Okay. Chart 13. Private clients bought. Okay. Look what they. Which one did I wanna? Okay, look, utilities, healthcare, staples, consumer discretionary, in the red right here. Okay, focus on those at the bottom. Okay, or being sold. Fund manager survey cash levels dropped 3.8% for two. Okay, that was like the lowest level. Um, and like right now it's at like the lowest level in like 2 3 years or something like that. FMS investors most net overweight stocks minus cash. Okay, like this is from October. Um, again, cash, staples and cash are being let go of. If cash is being let go of, that means they're throwing money into a bunch of other things. If staples being let go of, that means they're selling staples. Okay. Nah, go. Okay, again, staples at the bottom, energy at the bottom. Staples. I love staples right now. I love staples right now. I love staples right now. I just love staples right now. I love staples right now. Cash relative to history. Oh my god, this is crazy. This is just crazy. Percentage that say they're at overweight cash. What the hell? Lowest cash allocation. Current allocation is 2.3 standard deviations below its long-term average. Mamma mia, pizzeria. Investor sector allocations. Staples at the bottom again with energy. Oh my god, staples. Global consumer staples. Oh my god. Net 24% underway. Allocation to consumer staples lowest since April 2021. In 4 years. Almost going to 5 years. 4.5 years. Damn. 1.5 standard deviations below long term. Okay. Here, my commentary. I want you to notice how fund managers are positioning in staples and cash levels. Cash positioning is approaching levels that are typically seen at market tops, while the GOAT is at all-time highs cash positioning. Who is that? Warren Buffett. Okay. I do not share this to fearmonger. I share this for you to be prepared if the market suddenly changed like they did earlier this year. Okay. Do respond to the volatility. Do not react to the volatility. What I mean by that is if you're prepared when the volatility comes to you, you will respond in a cool, sensible manner. You would have already had a plan. Oh, I had told myself I'm gonna do this when this happens. Now I can respond to it. React, on the other hand, volatility comes to you. What the hell is going on? Oh my god, I need some cash. I need to sell this to raise some cash. I need to sell this to raise some more cash. Oh my god, let me buy the dip. Oh my god, it's dipping more. You're reacting. You're not being sensible. You're acting out of emotion. You're probably selling a company that has nothing to do with the sell off just to raise cash, and then you're gonna regret that company because come on. This is what I mean by respond, do not react. Okay. Um. Okay, right here. Look at what private clients have been buying, and then look at the market sector rotation chart. Okay, let's see. What was I talking about here? They had been buying what? Materials. Okay, materials. Industrials. Hold on. Oh, I guess I was just referring to that first one, which yeah, again, materials on top. Staples isn't there yet though. I don't know how I feel about the sector rotation one, but that cash positioning one is like a major red flag to me. Cash positioning at levels not seen in 2 3 years, dude. The market is built to mess with the most investors, traders at once that it can. What's the best way to mess with these people? Just ruggy when they're all in. What the hell? You really? Come on. But don't get me wrong. Look, don't get me wrong. People say if you're all cash or if you're too much cash, whatever, you're gonna miss out on gains. Whatever, you might as well ride the boat until you can't or until the tides turn, whatever, right? You could do both. You could do both. I kept saying something about my long terms being different from what's being crowded. Look, my US long terms, these are not tech related mostly. Um, look, just look in long term channel. Here, I drop. Here's a few, okay? Here's a few. Okay, Etsy is one. Etsy plus Depop. Let's say we go into a slowdown. More people are going to seek side hustling. More people are going to seek secondhand clothing. Secondhand clothing. This could be a tailwind for Etsy stock. Although in the short term it might get hurt. In the long term, it should be a tailwind. I don't think many people look at it that way though. KC Kraft and Heinz. People continue to buy condiments and mac and cheese in a recession, especially in a recession. What the hell? Come on. Brown Foreman, Diageo, ABEV. People would drink more. If we go into a slowdown, people would drink more. Yeah, drinking levels at 54% lows or something like that in years. I don't know, something like that. That was someone shared it to me. It was something like that. Basically, drink levels are at lows. Okay, in the U.S., maybe globally, because of the GLP-1s and all these weight loss drugs that mess with your appetite. But like, if we go into a recession, if we go to a slowdown or recession, people lose jobs. People are broke. People are gonna be. I'm sorry, but like people are gonna be sad. People are gonna want to feel good. People are gonna want to escape. They'll drink. That's one of the ways. They'll drink. People, in my opinion, I think people will always drink. It, it's been known for years that drinking alcohol is bad for you. It's poisonous to you, but people still do it. People still do it. Humans evolve, but human behavior doesn't really change. Human behavior doesn't really change. And if it does, it takes maybe thousands of years probably for it to change. But over hundreds of years, even hundreds of years, is probably a very short amount of time in the huge picture of things, in the big picture of things. Um, but yeah, I don't have Diageo, but I have Brown Forman and I have ABEV. Estee Lauder. Women will continue to buy makeup, okay? They have more money than previous generations. We go to a slowdown, whatever, but women nowadays have more money than they have had in previous generations. More women work now, okay? They'll continue to buy makeup, skincare, but Estee Lauder isn't only a US play. Estee Lauder's half US play and half China play. At least for me, for my thesis. Okay, my China thesis is consumer confidence will restore and people are going to start spending again because Chinese consumers do have money. They just have it saved up. They have pent up in savings. Once things get better over there, they'll feel better and they'll start spending money and they'll be buying makeup. Okay. Anyways, Vans, North Face, Timberland. Um, Vans. Let's say we're going to a slowdown, recession, whatever. Vans shoes, in my opinion, are relatively cheap compared to other brands that's just Jordans, Nikes, um, Adidas. Like a lot of the shoes are relatively cheap compared to all these other brands. Okay, and I see a lot of people still wearing them. Ibotta, you probably haven't heard of this one. They help promote companies discounted grocery items on their platform or other platforms. Um, and I think a slowdown or recession could be a tailwind for them. People will seek more coupons when grocery shopping. I don't want to. Yeah, it's kind of just. But again, on the screen, if you read, I write it in one sentence, maybe less than a sentence. It's that simple. That's the thesis. If we go to a slowdown, um, but yeah, I mean, but that's not all of them. I have other plays too, but you see the difference between that and chasing the hype, chasing things that have some headwinds coming up for them. Like, yeah, yeah. Anyways, well, that was that. Okay, let's go to the charts. It's chart time. I don't know how long I've been recording here for, but I feel like it's been a while. Let's start with Alibaba because my last episode was about Alibaba. Okay, and that was back in July 27th, I believe. We were down. Oh well, I need to put the chart up here. Hold on, I'm looking on my other screen. Okay, give me 1 second. There we go. That's much better. Oh, I need a full screen. Give me 1 second, okay? Give me 1 second. Whoa, when did my camera move? Or did it just move? Oh my god, I hope my camera hasn't been like that the whole time. What if my camera has been like that the whole time? Whatever. There's only one way to know. That's by checking later. I'm not gonna record this all over again. Okay. Okay. So that was okay. So many lines, right? So many lines. That was back here, July 27th. I had said I expected to move to like 140, 130s maybe. My god, this move was crazy. Dude, I sold most here at 130s, I think. Yeah. I was all out by maybe 145, 150. Yeah, like 150. I was all out by here, by this day, 9/11. And then the rest I missed in options. But of course, I'm still holding my shares full. Okay, but before we move on, I need to check this because shoot. No. What happened to my charts? Sorry, give me 1 second, please. I have some charts. Oh shoot. Okay, here they are. I charted this at the end of October because I knew I was gonna take November off. So it's like I'm gonna chart what I see on these charts and then look at them again in December to see if they're ready to. Because these were my favorite charts or setups at the time. I wonder if I added Baba onto here though, which seems like I didn't. Okay, fine, whatever. Anyways, the move happened, whatever. Let's go to a weekly chart. I was gonna go into like what I saw last time, but honestly, you could just listen to that podcast, the last episode, and see what I saw. But what I see now, what I see now is people on Twitter posting this flag that they see, which makes me think that Bob was probably gonna need a little bit more time before I long it, because I'm looking to long it again. But either I'm gonna wait for more sideways action, which maybe January or end of December, or I'll just wait for it to heat up again, and then I'll just ride the wave. I'll just ride the momentum. I don't know, but I don't have an issue with it if it wants to be sideways up until February or something like that. I don't know. Like I don't. Let me change this. 817. So 817.9. That's for looking for bottoms, and 1226.9 is for looking for tops. We want to look for bottoms here, okay? Yeah, I don't know. I don't have a rush. Maybe wait for the 200 to catch up. I don't know. There's no rush. Whatever. Papa, I love it. Okay. Let's see. What was I looking at here? The first chart. Etsy. Okay, I was looking at the fibs that I drew out with no indicators. So let's do the same thing here. Etsy. Fibs I drew out, no indicators. And what time frame was that? I don't know. I don't know. Was it daily or the weekly? Here, I drew a trend. The trend line broke. That is not good. I have some January calls that I bought a while ago, and they're red. I think I need like, yeah, they're like 80 strike calls for January 21st, something like that. Cooked. Probably cooked. It is what it is. Yeah, I bought them like at the end of October. I was like, oh, probably like, I thought honestly, I thought IC would have bounced, held about above 55 and been fine by the end of month of November, but got that one wrong. Both trend line things don't look good right now. Let's look at the weekly chart. Yeah, it's not looking good. What else did I draw on it? Let's see. Okay, we have the weekly super trend and 20 EMA. Okay, let's take off this. Let's turn on the super trend and the EMAs. Okay, here's one good thing. It's holding the green super trend, but we would need it to bounce right about now. Yeah, AC doesn't look good until it gets over 61. But I'm not trying to catch knives. It is what it is. Advanced Auto Parts, 20 EMA, Super Trend, 1 week, and okay. Advanced Auto Parts. Okay, let's compare it to okay back then. Let's see. It held the super trend. Oh, I'm missing the 50 here. Sorry. Held the 50 EMA. It's trying to break over the 20 EMA, but it hasn't yet. And I can't buy more until it breaks over. This chart said it probably takes a little bit longer. However, it's looking good. It might even come back down here again. Whatever. I have March calls for that. March 65 calls. I have a lot of time. It's okay. But it's a good first sign. Bounce off the super chain. Good first sign. AP. Okay, let's go to the 1 day and the MAs. Okay. 1 day MAs. Probably have the super chain off. Okay, the daily. What do we have here? We have, it was below the 200 MA. Below this, we have like a trend flip here now. Above the 200 and 250 MA. Retesting the 50 MA. Struggling. Could come back down like this and then back up. Or just reject and fall way down. I don't know. So when I don't know, I let it do its thing. Not adding more. So far, it still looks good, so I'm not cutting either. So this, I just have to let it do its thing, okay? I just have to let it do its thing, but so far, all right. Okay. Not bad. Next. Goose. My favorite at the moment. Goose. You see those lines? My God. Let's go here. Let's go here. Oh, that was part of the weekly chart. Sorry, I have all these fibs, but do you see what's going on here? Okay, look at that. And then look at this. Oh, the 1 day. God damn it. Hold on. 1 second, please. Okay, here we go. Let me change the candles. Like that. Maybe these are fine. Okay, you see it? Do you see the setup or not? No, it's this one. Yeah. Tell me, do you see the setup? You see that? And then you see this. Do you see it or do you not see it? Because I see it. We're going for that breakout already. Let me draw this line big. I'm sorry, I have those fibs, but I can't delete them right now. I'm sorry, I can't delete them. Just focus on that big outline. You see that? It broke. Retesting it. And I hope this cooks because I have some 18, maybe even $20 calls for April. I'm looking for these fibs right here. Do you see the? Oh my God! Just look at this. Just look at Goose, man. Drawing tool. Do you see that? Oh shoot! Look. Do you see the vision? My goodness. Because I see it. Anyways. Okay, Goose still looks good. It had a dip in November. But, oh, Generac. Oh, sweet babe girl. We have the 200 MA here and fibs. Okay. Generac. Let's cover the EMA. The MAs. Okay. Only the 200. Oh, this was not good. Look. This one broke under. Broke under the MA. The EMA. It's retesting it now. What I chase here? No, because it could just reject and come back down and then go back up later. It could consolidate for another month and then go up. Or it could just V-shape. I don't know. But I'm holding like January, February, March, April, June calls. Like every single month. January calls are probably cooked unless it's probably cooked. No, it is. Unless. Or anything. Probably cooked. Whatever. I have accepted the fact that it doesn't matter. Retesting, whatever. We'll see what happens in the next couple of days. One day. Zoom out even more. Okay, zoom out even more. But the Stotch and the MACD are pointing up. I don't know. I mean, yeah. This is gonna, yeah. I'll have a better picture of this next month. Because it could go up like this and then down and then up. It could go down here and then down and then up. Or it could just be, yeah. Again, I don't know. So, not taking any new positions on this. I had only been buying shares. I had been buying shares all this whole dip. Just buying and buying and buying. Whatever. Because you see here, it would ride the thing right here, it dipped under. But you see, sometimes it dips under like this, and then it goes back up. So I don't know, but whatever. You see that descending broadening wedge. It broke under it, but yeah, so it broke under the descending wedge here late November, mid-November, but it went back up. So the setup is still there. I still see the setup intact pretty much. I don't know what a broadening wedge is here. Yeah, so you see, this one's pointing down, so it would be like this one right here. This one right here. Like, see this pointing up and then it goes down, this pointing down and then it goes up. But do you see what I'm talking about here? You see this? Let's go to here. Let's go on the weekly. Do you see what's cooking here? Because I see what's cooking here. On top of that, we have a cup handle. Although the handle got pretty extended. Like, do you see? Oh my god. I'm looking at the weekly setup. If this weekly could retest whatever this was, 163, by Friday, and hold, this might be set for an absolute ripper. Yeah, it looks good. I have a this is my favorite stock, general. My favorite U.S. stock, because my favorite stock is Alibaba. It's my favorite U.S. stock at the moment because it has like the most tailwinds in my opinion at the moment. Oh my god, I just I love this setup so much. It infuriates me because I just I love it so much. Just look at this setup. Just look at this setup. Isn't it so beautiful? Isn't it so beautiful? Just look at this. Look at that. Look at this. Look at that. Look at this. How long will that take though? Okay, assuming saying if I get there, end of December or January, get their breakout in. This could go back to 200 by January, end of January, and if that were to happen, maybe my January calls are not cooked. But I don't know. Again, it has to have a solid break through the 200 EMA. If not, then yeah, I don't want to. The chart looks good though. The chart still looks good. Look at the weekly chart. Just look at this. The weekly chart. Let me held the Ichimoku cloud. Oh, trying to break over the 200 MA, trying to hold above the 200 EMA. It's just this 250 EMA, but it's okay. Oh wait, I forgot to turn on my shorter date EMAs. There we go. Yeah, like yeah, this needs this needs 165 and over for me to start playing calls again. Under 165, I'm just letting my current swings touch. My current swings got messed up on this pullback. My current swings are bagged at the moment. But there's no rush. I have a lot of time for them too. I did buy a lot of shares in the like. When I tell you I bought a lot of shares, I bought a lot of shares. I like tripled down on my position. I had like a 127 average. My average now is like 154. I kid you not. My average is like that's how much conviction I have that I brought my average up from 127 to 154. And let's say it drops back down to 100. I don't care. I'm not gonna get scared. I have a plan. I'm prepared. I'm ready to respond, not react. Remember? Looks good, huh? Anyways, I think that was all that I tried. Those are my swings. Some most of them are down. Sweet green. I have some lotto calls that are back like negative 80% that I bought mid October. Recovering though, hopefully I could get out break even, whatever. I have some long dated TSM puts. Nah, it's like June expiry. Um, it's been bumping. It's been pumping, but I don't know. Yeah, I might be good. Look at that spinning top on the monthly candle. This is why I'm not bullish right now. Look at that hanging man on the Nasdaq monthly. Look at this doji. What is it like? It's it could qualify as a hangman, but I'm pretty sure it has a different name for it. Um, right here at the monthly high. Oh my god! Like, are you serious right now? Are you serious? I might have to take some puts actually on this. No, look at the daily candle. Daily candle could keep going up. But look, this this monthly candle, the top, the high is 685.80. So the short thesis for that candle could be intact as long as 685, whatever thing is. And it rejected. It rejected. So Whoa. I want you to see something. I had been looking at this right here, and it broke above today, obviously, at this range, but this might be a wick off distribution. This here might be a trap. This here might go like this. Do you see what I mean, or do you not see what I mean? Let me try it in the color that it's supposed to be. Look, do you see what I mean, or do you not see what I mean? This is very interesting. This is very. Let's look at the 1 hour, 4 hour, the daily. I have 15 minutes. I have 15 minutes to decide I'm gonna swing some S&P 500 puts or not, because this could be wrong, and this could just keep uptrending tomorrow because it's technically a breakout. I'm technically supposed to wait until the breakdown to actually short it, because if not, then this is just a breakout. Anyways, monthly candle, that was fine. Just not good here. Not good here. Look, let me show you what I'm talking about. Well, remember that spinning top that I said on? Oh, that's not spinning top. It was just a regular doji, but like thicker, like this, but it was green. Whatever. Here, hanging on candle. Man, that notification scared me. Where is it? Black line fell. You see this? Do you see this? Do you see this? You see that, right? Look at that. And look at that. Look at that. Do you see it? Because I do. I see it. Look at this. My hair's all messed up right now because I haven't done it. I've been wearing hats all day. Go to NVIDIA. NVIDIA. That's not nice. Let's look at all the mech sets. Let's look at Microsoft. Let's look at Google's strong though. Google should be having a good candle, yeah. Apple, I think, should be having a good candle too. Yeah. Meta. I don't like Tesla, but let's just look at it. Yeah. The thing with this right here is it could push. I've had it happen to me where it pushes above the high, pushes above that previous candle high, wicks up here, and then it comes back down. Or that could not happen. I really don't know. Super trend here. I would be going against the trend in anticipation of this reversal setup that I see. No, I have to take it. I don't have to, but I think I want to. I'll do 6. If this is a top, this would be the top, and I'll take a tight stop. But then, if this goes to 685, I'm gonna want to hold. I know myself. I would literally hold until 695. How far is that? That's too far. No. If I want this to work, this has to. Oh my god. What's the expiration? 12/05. That's literally still in the same week, so I should buy some Friday or Monday expiry puts for, if this were to work, then 679, 680. 680 put, but then they 681 puts. 681 with some size, maybe. Let's look at the balls. Fuck. Anyways, whatever. I could have stopped this a while ago. I'll decide, and I guess you'll find out soon enough. But that's all I have for today. Later today or tomorrow, I'll pile up some zero hedge articles. Some Barron's articles, see what I find. Maybe some Charles Schwab articles and see what's up. But yeah, that's what I see right now. Thank you. Again, not financial advice, opinion only. Speak to a financial advisor before making any financial decisions. I'm not liable or responsible for any of your financial decisions. And yeah, thank you for watching.